Yeah, what's great? All we do is numbers. I'm in the building. You already know it's your boy Eddie One Take. Back with another video, trading for the trappers. Make sure you take risks and profit. Today is a beautiful day. It's a day we never seen before and a day we'll never ever see again, man. Today we're gonna learn about Fibonacci. We're gonna keep it simple and we are going to get educated. So starting off, we got a blank chart here. I'm going to be demonstrating Fibonacci specifically for entries. This is not the total strategy. If you want to learn more about the total strategy, go ahead and jump in the free Discord. But this Fibonacci training came about from one of our community members. Shout out to Sam O. He wanted to know how to use Fibonacci's specifically to get better entries. So that's what we're going to demonstrate here now. I'm going to leave some reading references in the Discord, in the Trade for Trap Discord, some books, and this book right here is for Coursera. Basically, it's a platform you can study on and everything, but I got access to it, so if I got access to it, you got access to it. But this book comes with YouTube videos. So you see lecture 1, you can click on that. It'll take you to some YouTube videos, and this is some really good breakdown on Fibonacci. Now, these don't apply to trading. I'm going to show you how this applies to trading, but to understand the overall concept of Fibonacci, you're going to want to at least like skim through this, right? And this is the actual book that Fibonacci put together himself. Fibonacci was a mathematician. He was born in Italy, Pisa, Italy, and he was a super fire mathematician. This is his book here again. And Fibonacci's been used for like 800 plus years, but if you pay attention, it's funny how we never heard it in school. Some people never ever in their life will hear about Fibonacci, or some people will learn it like in their late 20s, 30s, or whenever they start trading, because Fibonacci is used a lot for trading. So let's go ahead and demonstrate how to use Fibs. Give me 1 second here. Let me get my stuff right. All right. So this is how we use Fibs, right? Specifically for getting entries. Let me find a good area on the chart and we'll start charting. I'll do 2 examples real quick. I'll do a uptrend and I'll do a downtrend. So let me go ahead and just mark out a zone. I'm just going to mark out a range and price specifically to demonstrate Fibonacci. And let me know if y'all want me to do a TradingView tutorial too. If you want to know how to use TradingView to do your charts the right way and all the right tools, let me know, man. So I'm gonna do from this low to this high right here. Trying to get precise. All right. Excuse me. Put it right there. Oh, tripping. Hope my audio is good. Hold on. Testing. All right. Audio is good. So we're going to do this range right here. I'm on the hour chart because this is specifically for entry. So I'm on the hour chart. Again, this is not the whole strategy. You don't want to use just this to enter trades. This is one of at least 4 confirmations that you would need to get in a trade, though. So we're going to go over Fibs. Now, we got a clear uptrend right here. We're going to use this zone from this circle to this circle, right? So that's our range that we're going to be basically trading in. Now, this market is moving in an uptrend, right? Right after a downtrend. So which one should I start with, man? Uptrend or downtrend? This is a beautiful downtrend, but I'll start with this uptrend, excuse me. So we have the market coming out of a downtrend, and then we have this high right here that gets traded above right here. Okay, so I'll just extend that through. Now, when this high gets traded above, it closes below and then it retests it and it starts coming back down. So let's say you were considering looking for buys because you felt like this market started to turn around, and there were other indications that it started to turn around, like breaking these highs here, retesting and going up. But let's just say you seen the price start here and it went up and it started coming back down. Fibs is basically a tool for measurement. It is a sequence of numbers that, wrong tool. A sequence of numbers that helps you understand the measurement of a pullback in regards to trading. So I'm going to put my fibs on the screen, and then I'm going to go ahead and allow you to copy my settings. These are the settings that I have on fibs. You could do it all on one side if you want to. You don't have to use both sides. My colors are at 50 because I don't like them too bright. It kind of gets noisy on my chart when I'm trading with other tools. So I got it at 50. Yeah, so go ahead. You can pause the video and screenshot this. Let me scroll down. So this is what I have my fibs set up as. My trend line is on 10%. My levels, my lines, things like that. All right, cool. So this is fibs, right? And if you want to look for fibs, or if you want to get fibs on your trading view, I think it's the second option here. You want to click the side arrow and hit Fibonacci Retracement. I have it starred because I use it a lot. So I will draw it right here so you can see. So depending on what side you draw it from or which side you're going in to look for a trade is how you will draw your fibs. So if I'm looking at a downtrend, I'm going to start at the top, at the high, and then draw it down to the low. And then if I'm in looking for a buy, I'm going to start from the low and then go up to the high. All right, so I'm going to demonstrate how it's used right now. First, let me explain the fibs and then show you how it's used. So we're going to use this in a buy example. If I just click my fibs here, wrong tool. If I click my fibs here, let's say this is an imaginary low, and I draw it to an imaginary high, right? What this basically shows is this, and let me move away from the chart so I don't confuse you. We only got a few things on our charts. The high, or the low, the high, the direction of the trend, and the last high that was broken that is starting to show a break in structure or a change in structure coming out of this downtrend. So I'll just go to the all black on my charts, show you this example. Let's say we want to figure out where is a good place to get in the market. I have fibs drawn out, but the chart would look something like this, right? Starts at a low, price has been coming down, starts at a low, and then the price will, let's say, shoot up, right? From 1 to 0, right? Should be the other way around, I think. But yeah, let me hold on 1 second. Let me put 1 here. And then 0 here. Still did the same thing. All right, so from 1 to 0, right? Yeah, so this is right. From 1 to 0, this would be the movement of the market. Now, fibs is used like this, right? You see, oh yeah, this 1 represents 100%, not 1, but 100. So 0 to 100, right? And then you have the negative numbers up here. We'll get to that. But let's just say the price was at 0, or the price was at 100, right? And then it went to 0. And you want to buy it, right? You want to wait for the price to come back in these zones for a discount. So this 0.236 is 23% off. So that means that if the price was to fall and touch this line, it would be 23% off from where it originally was, right? Now let's say it goes to this line. That means it's 50% off from where it originally started. And these colors, the gold is the golden retracement area. And if you look at the Fibs book, I'll put it in the books section in T4T Trading Discord. The golden retracement zone is an area where you can expect some type of reaction. So let's say the price drops down in here, right? This means it's 50% off. This means it's 60% off from where it first started. Then the price drops down, right? This means it's 70% off, right? So if something was $100 and you missed the sale, you missed the free sale, right? You wouldn't want to buy it when it was, first of all, you wouldn't want to buy something when it's free, right? And if you could get it, because if it's free, it's free. You don't want to spend money on something if it's free. But if it started at a certain point and it went up and you missed the sale, you could have got it for 23% off, but this isn't the best place to buy because you see the price still comes down to 50% off, 60% off. This is 70% off. And sometimes the price will even give you an 80 or 100% off. A lot of times it'll give you an 80. If it's like a deep retracement, it'll give you an 80% off and then start moving up to the negative numbers, which are the TP. So Fibs is very simple. If you are looking for a buy in a bullish market, you would want to wait until the price at least comes down into the golden retracement area before you feel comfortable to take a buy. And I'm going to show you this on the charts in a buy example right now. I try to keep these videos short because this stuff is very simple, and then we go more in depth on it in the Discord. Now, that is Fibonacci retracement simplified. Any questions, just make sure you go ahead and shoot it in the Discord, ask me, send me a message, whatever. But look, let's use it in this example, right? So we just broke this high and the price continues to go up. I'm on an hour time frame and I want to figure out where would be a good place for me to start looking to get in this market, right? The price starts here and it ends here before it starts coming back down, breaking structure, right? The whole way up, the price was going up, but it wasn't like completely breaking structure, not like it did here. Here's the structure that it broke. And you know it broke structure because this is one of two things that make up market structure, which is a disproportionate candle. There is a disproportion in the market at this time. There are no buyers in the market at this time, right? See how it tries to go up a little bit, but when this happens, there are no buyers in the market, only sellers, and this happens underneath a low. So that broke structure and it starts to come back to this initial area where it took off. So what I want to do is grab my Fibs because I'm looking for buys. I want to grab my Fibs from the low, the body of the low, to the body of the high right there, right? So I'm going to put it here, but I'm going to extend it into the future. All right, so very simple. From the low to the high, because I'm looking for buys. From this low, from this low to this high is the range of movement, and then when price breaks structure and starts coming back down, I can draw my Fibs out. From body low to body high before it starts coming back down. So we can see it comes back down, gives us a 23% discount right here before it pops back up, closing this gap that it made, right? You see I extended. It fully closed the gap and then broke another level of structure to the downside right here with a what? Disproportionate candle, right? Now you can see it starts coming into 50% off territory. It comes into 60% off territory. And look at how you get the double bottom at 70% off. So when you start seeing market patterns this deep in fib retracement and you start seeing a pull away, you can start to look for your entries on smaller time frames. We're going to stay on the hour though, just to explain this real simple. I'm going to try to keep this video under 20 minutes. But price drops down, back in to get a 60% discount, and then goes back up to the 50. So in this area, you see you got the most reaction, the most touches within this golden retracement area zone. And then you can see how the price never comes back down there, right? It takes out, it goes to TP1, which is right here. See how it trades up to TP1? You would have been in profit. Your trade would have got, your take profit would have got hit right there. And why right there? Because if you look in the past, there is a disproportion in the market. The market was going up, and then it came down with the disproportionate candles that left gaps. So if we look at this right here, where the market left a gap, and we extend that into the future, we can see why the price is having a reaction at this level. Okay, very simple. So the price came up, hit TP1, it consolidated, never came back down anywhere here, and then it hit TP2, and then they even went all the way up to retest these highs before coming back down. So you can do this. Let's just say you missed this movement, right? And it came back down. Oh my God, you missed the movement. What do? You just draw fibs from the low to the high. The low before the break of structure. So if this is structure right here, which is a high, say this was the last high, and the market gets broken above, you can see the algorithm kicks in. But you want to draw your fibs from the last low before the structure broke to the last high before the market started coming back down. So let's see where we could have got an entry on this if we missed the first one. All right, perfect. Again, we see the price went up, came down 23%, came down with an engulfing candle, breaking structure, disproportion, which is one of the two most important things that make up market structure. Excuse me, my magnet is on, so keeps on hooking. All right, boom, we got the break of structure there, and look at where the price falls into, right? 50%, 60% discount, pop above, play at the 50, give you one last retest before going to do what? Hit the TP1 and then also hit the TP2 right here. So that's fibs in a nutshell. You can see it play out every time a high gets broken. It's gonna retest and give you a better price to enter at. So we'll go more into some psychology. I hope that made sense. Shout out to Sam. Yeah, you already know, man. All we do is numbers turn up. It's your boy Eddie One Take, man. If you get caught turned down, your free band pass gets revoked. Let's get some of this money. Trade like the banks.